Hello guys, glad to have you on board again today. Hope you had a great weekend. We're gonna start right now with the Bitcoin and then switch to other cryptocurrencies. We've had an interesting weekend, as you have it in the chart in front of you. We're in the daily chart time frame. So this is yesterday's session and this is Saturday's one. So big bearish burst into Saturday's session. We've been stabilizing into Sundays, and today has been trying and already broke above the Sunday high. So this is nothing like a bearish signal actually right now. Nothing bullish either. It's just trying to figure out if we're going to outburst what we've done into Saturday. As long as we doesn't invalidate this or get to test that area once again, the market must remain very dangerous, which means could be bearish, and at that point trading it aggressively bullish is nothing close to viable, as we've been restoring prices below the 7,200, which is a breakout level. You can clearly see that there is no volume in here. We obviously need to restore the prices above that area and get back to the 7,500 and eventually in the end there, and eventually going slightly higher. As we've been making higher lows and higher highs, I think if we somehow find a support in here, then this makes sense for the market to just go slightly higher afterwards. So the question is, are we going to find a support in here? We're in a technical level, as this was the price we've been opening into back then here in we've been closing to, or whatever this is. No, this is a technical price, and yes, this is where we've been opening back then. So we've been opening at that price. So basically that's the price of the 1st of April that we're currently trading. So which means we're back into April pricings, and we've been lower, we've been higher in between. So this is somehow, I think this is subject of a range, as we're just trading month back pricings, not having managed to break down support or break up resistances. We've been doing anything of this. We've been trying to break down support and failing. We've been trying to break up resistances and failing as well, which means clearly this is a range scenario for now. And to me, that range structure clearly is some kind of a triangle. So I'm patiently waiting for now to just try and assess if Bitcoin is still the market driver, or if right now Ethereum's and other altcoins are the one taking the lead. And this is a hard question and yeah, it's a tough question to answer. But what we have in front of us is not suggesting anything like a bearish move to do right now, especially on the Bitcoin. Because what we do have here is very dangerous. Yet first, we've got an oversold momentum right on the support area. We've been overlapping that previous resistance, which is now supposed to be a support. So we're oversold on a support. And moreover, the momentum is overstretched. We've gone straight from overbought patterns to oversold pattern, and generally that doesn't suggest anything like a trendy market, but a rangy market. So in ranges, what you want to do is to figure out the range boundaries and try to trade risk-reward ratios in between. So the fact that we're trading right here above potential support area means that if somehow we manage to find support in there and failing the breakdown, because just have a look at this. Yes, we've had low volume in there. Okay, we're just going to zoom into that area. Okay, I'm going to zoom in here. Just let go. Just let the time for the market to figure out the volume profile. Come on, give it to me. You're not doing it. Shit. So it's either we go there and we find the support area, and we get back to the previous wave one, which we shouldn't, or we manage to find some support in here and fail as we oversell, and we get there, basically overbought, oversold, and we're just going to oscillate in between. Not to say we could go just slightly higher, as we've been making higher highs and lower highs and higher lows, which means we should go do it one more time approximately there to just find sellers at interesting prices and potentially fall afterwards. So I'm pretty much maintaining the previous scenarios right now. Sine wave is in the potential reversal area. We're oversold into a support, and we've got a beautiful bullish hidden divergence. Just to set things straight, previous low in here confirmed by sine wave and momentum as well. So we've been making a valley in here. Okay, so valley, peak, As you can see, the peaks are higher, the valleys are lower, but the prices remain bullish. This is what we call hidden bullish divergence. We've been making a lower low in momentum, but far from doing the same thing regarding the prices. So if for some reasons we were to reactivate in here, it means that we're going to make a new high generally. A divergent new high, but probably just going slightly higher, and this is still what I forecast right now, to just go a little bit higher, in which I think those prices will be interesting to sell, but not these ones. And probably, and certainly not these ones. If you're selling right now, great danger. You're selling a potential support area. And this is not what I'm trying to teach you guys out there. Okay, so now second question is trying to figure out what the hell's at play with the Ethereum. Same thing goes in here, but in a total different pattern in here, because we've got price and momentum kind of diverging in here. As you can see, we've been making higher highs and lower lows when the momentum is contradicting with making only lower lows and lower highs. After a contraction right here, which is a squeezing pattern. So in here you cannot trade. The fact is that if you were bearish, the bearish extraction out of this was something you wanted to trade, as you had a double bearish signal in here, so you should have entered in here, rise the stop loss regarding the risks of that squeezing pattern. So at that point in here you should have broaden your stop losses just according to the potential volatility induced by that squeezing pattern. Lucky you, the squeezing pattern got to the downside, which means at that point you just have lowered your stop losses at break even and just letting that market go down. As long as it goes down, you're right to do it, to just let go. But the thing is that right now we're oversold. And as so far we haven't managed to go lower than that, this is danger for the bears, which means the bears in here haven't managed to install a trend even though they had that squeezing pattern. Because generally what we call a trend is a market that isn't trading in cycles. Okay, as you can see, this is a trend. We've had a trend in there. This is a trend. Clearly, as you can see, look at sine wave. It's just totally lost. It doesn't figure out anything close to cycles. Okay, this is sign of a trend as well in here, perfectly sign of a trend. What we have in here is not showing any signs of trends yet. To install a trend, we'll have to break down that support, and so far we haven't. So oversold on a potential support with a market that is still trading in cycle and suggesting that we're in a bullish cycle right now. So if we have bullish cycle with an oversold momentum, believe me, you don't want to see a blue candles coming out of it. Because if that's the case, then we're going to reverse the squeezing pattern and do the exact opposite, which means this is a wrong footing pattern and this can happen. You know squeezing pattern is dangerous to trade. Lucky you if you were trading it bearish, because for now you're out of risk, you're not going to take a loss. But if for some reasons the market gets back there, means that it's going to wrong foot those who've been trading it bearish, and we're obviously going to take down the stop losses, which means we're going to go there and we're probably going to go slightly higher just to take down the stop losses. So this is the area I'm forecasting right now regarding Ethereum, and what is really interesting me right now, or catching my interest. This is not good. This is nothing close to be good, but this is not bad either, and this is not end of the word, because we're nearly nothing close to a technical price area in here. Okay, just to be really fully clear in there, we've got two technical prices. We got first one in there. Okay, this is the first technical area. We've got a second technical area, which is the double bullish signal we've been building. So we've made a double bullish signal in there. Just me to zoom in here. This is the one I've been tweeting about and making messages out there. So you basically, we build a support in there. Okay, so this is it. You just take all the low shadow candles and things like that. As long as we remain above this, means the market is supporting. So this is what you want to break down in order to validate that signal, because for now it's happening near nothing. In here there's no technical prices. There is two options. Either we go there and trigger another double bearish in here. Sine wave's already bearish. So to set things straight, it's either we go there, find a new bearish momentum pattern, and then this becomes a resistance. And in that case, I'm ready to have a bearish and clear tradable double bearish signal. But trading it right here might be dangerous. It could just drive us slightly lower to make new lows, But if we don't have a bearish breakdown, I mean, what I would like to see is a breakout pattern. If we don't see anything close to this, I think this is just going to be a range structure in here, ranging just to go higher afterwards. Just have a look at what we have in the weekly chart in there. We have a pretty nasty bearish candle in here, and we could just make a doji candle in there and have a bullish next week. And that would just be a morning star pattern, nothing close to a bearish signal. Could just do this, bearish candle, kind of neutralizing, and pretty nice bullish candle afterwards. So those who think this is already too late to buy altcoins and things like that, I don't really think it that way. I think that market is just trying to figure out what's at play right now. And we've got no more than two options. It's either we just fall apart this week, and if we somehow manage to end all things in here, it's not going to be a bad sign, okay? So it's either the bears manage to break down the support, and then we're going to close next week below those low, and in that case I'll be off that market for sure and not be into trading Ethereum again for a little while. The second option is just we hold on there, or worse than that, we just reverse the previous week's low, the previous week's bearish candle by making an upper shadow candle, a bullish engulfing pattern, in which we're going to close higher than the previous week's high. And if we do this, then this is a wrong footing pattern, suggesting I was right regarding the daily scenario. If the bears have failed that squeezing pattern by just overselling momentum but didn't manage to take down the support, I mean, that means the market didn't want to go down, and it's just doing this to trap some bears and wrong foot them. So this will be a wrong footing pattern that will be triggering. False breakout, bullish market that is taking it over, and in that case we're going to have to trigger the stop losses, which means this is where I'll take the gains, but we'll probably have to go slightly higher just to trigger some bear stop losses. Okay? So this is how I see it right now regarding the cryptocurrency sector. Nothing close to be over bullish, nothing close to be over bearish. It's just the market's trying to figure out if we're going to hold on that support or not. So it still says one thing: you have to remain speculative. There is nothing close to possibilities of being leverage trading right now. It's just waiting to see what the damn market is about to do right now. We're oversold into support areas, which means it's really a binary situations. Either the market keep on pushing below oversold levels, which means we are trending to the bear side once again, or we cannot push further enough, which means we can try, it's not working, and at some point we're going to wrong foot the bears who've been playing that game, and we're going to take down their stop losses to those who won't surrender. So if you were a bear, I mean, that's good for you. You can just hold on and let the price go down, and if we keep on pushing below oversold level, then good for you. You'll have a nice trend to ride at good prices. Option number two, you are about to be wrong-footed, and in that case, if we're retracing back to the entry prices you've had, you really should consider taking down your stop losses, not reversing to bullish, but just assessing the fact that the market is probably about to wrong-foot you, and it's going to chase your stop losses and hunt you down like you were beasts. Okay, so if the market is going for a stop hunting, for a bear stop hunting, then it means that you don't want to hold your bearish positions, and you might want to just surrender and give them out, and rather, instead of just taking a huge loss in the end, just get to release the gains you've had, or take tiny gains and just move on to something else. It's really a battle in here. Bulls can win, bears can win. It's pretty much hard to tell. But at the current time, the only ones who can trade bullish. So it's either, as a bears, you secure the trades by taking 25% profits, for example, if you want to, or you just wait to see some kind of bullish reactivation. But if bulls are taking it over right here, I mean, we're probably about to win the battle, which means we're probably going to have to take down your stop losses if you're not giving them soon enough. So moving on to the other asset classes, in which I think the still big things are still at play. Still trying to figure out the damn thing regarding the Nasdaq. So Nasdaq's not doing well right now. We might have the candle close at that point. Not yet. We'll have it in 10 minutes, and it's going to be a bearish signal, and it's a double bearish signal. To just be straight in here, what you have in here is clearly a divergent structure. I'm just going to show you that. Okay, clearly a divergence. We've got everything we need. The momentum has been making two clear oscillations, so we're not diverging into the same sine wave in momentum oscillation, and sine wave have also been following that oscillation. As you can see, oscillator has been making bullish, bearish to bullish, and the two levels are divergence. We've been doing the same with sine wave: bullish cycle, bullish cycle, and now we're in bearish cycle. We clearly tested two different levels: first level, second level. So these are the necessary conditions to validate the divergence. So what we have in here is a divergence. Generally, first target is to get back to the in-between support, which is right here. So normally, from what I can see right now, Nasdaq is about to go there. And if it does that, it will be really hard to tell. If we're breaking that down, I think the bears will be in control and that the sellers area will be winning against the bulls. And if that's what's at play, I think that might be interesting to just put some more money into the Nasdaq bearishly, heading toward trigger of that daily signal, as the daily signal is sweetly bearish. In here we've got a really tiny divergence, and this is what bothers me right now, because we clearly had the red triangle in here out of an exit pattern, and it's nothing close to something you want to ignore, but we didn't manage to trigger a bearish signal in here to confirm. I think we were just close to trigger an overbought pattern in there, but we didn't. And the fact we didn't is really worrying me about the fact that I don't know if the Nasdaq has just trapped us in here and just trapped the bears to wrong foot us and go higher. But anyway, we'll remain into an exit signal, which means it's nothing you want to buy. Even if for some reasons we were to take down the stop losses of bears like me who've been trading in there. But, I mean, buying is out of context. It's just searching for sales right now, and don't be too aggressive. And if you are aggressively selling like I did, just do it with very low leverage. Accordingly, don't put yourself into the red area in which you're going to be forced to surrender the stop losses if the market is keep on pushing. Okay, let some room for the prices to work the area. If you're trying to speculate, just once again assess the fact that you're never ever going to be able to control anything. You can have some mind projections in which you get yourself into confident trading areas, psychological confidence to get the trades in the market and let them go. Okay, so it's just pure mental projections when you're doing this. You're never ever controlling the market. Okay, so let the room for the prices to work out the areas in which you're speculating, because things will generally not happen to be the way you thought there would be. Can be slightly different, even though all you should care about is for the scenario to go search for the taking profit instead of the stop losses. And even though initially you had a mindset, a projection about the wave counts and things like that, the way the market should look like, generally you'll see that in the end it didn't happen that way. But what matters is not controlling the way the market will behave, but just fucking taking the taking profit instead of a stop loss. That's all you should care about. So let some room for the market to evolve, and not necessarily the exact way you predicted it should do. If you're getting out anytime the market is not behaving the way you thought it should, then you're going to take stop losses all the time, and this is not how you're going to get a winner. Okay, so things are really important in there, and I think we should really consider just opening that second chart again to just think it that way. It's what we call the danger quadrant. Okay, and as I said, it's not changing anything in there. We're still trying to figure out what the hell what the hell Wall Street's doing in there. They're just like trying to keep on pushing with the dollar. This is the only one that is not included in the quadrant, but should be indeed. It's the fact that what we have in here is really. I'm laughing at this because I'm just going to be real straight in here. I just figured it out, and I think I'm just going to publish something as publish into TradingView, because I think the comparison is really funny. So let me just do it for you. I'm just going to do this, go there, and just put the goal, and you'll see what I mean. I mean, doesn't this sound familiar to you? What we've done back then. I mean, just if you go there and just figure out comparing this, don't you really see the confluence of elements in there. To me, it's the exact same. I mean, this, yes, look at it this way. This is how, damn it, this is how it looks like to me. Making the bearish moves after finding a resistance. We can even go, yeah, I mean, we should hold it this way. And then we go up, a little bit down. So the waves are not the same, but the cycles and the psychology is the same. We've been accumulating a lot higher in here, but we've been accumulating bullish bursting, accumulating to bearish burst. So this is what gold has been doing afterwards, and I think the dollar is about to do the exact same thing, just trapping once again a lot of stupid bulls who think the dollar will be up forever, as it is, and I maintain this, a bearish asset. Dollar isn't bullish in the long run. Dollar is bearish, and as we're heading toward potential new recession pricings, dollar probably is going to be triggering bearish as well in the next following month and quarters. It's a long-term scenario, so once again, don't think it that way if you're trading intraday, because there's nothing you should care about in here. But if you're trading weekly scenarios and things like that, you should really consider that the dollar is overpriced at the moment. This is dangerous, and at some point it's going to have side effects, negative side effects. For now, we've been seeing only the positive effects. It's like when dollar was bearish, equities were up. It means bullish yields, bearish dollar, accumulating capital, attracting into U.S. markets because of good pricings, and weak dollar was just attracting money like magnets. And right now that we're having a bullish dollar and bullish yields should be a concern, but the market didn't really care about it. I mean, right here, we should have been worried about a bullish dollar and bullish yield in the same time, but the market just flushed that out and decided, fuck it, we're going to go higher no matter what. So this is not normal, and this is where the price distortion have been starting, because in that context, bullish gold and bullish dollar and bullish yield shouldn't be a bullish bias for the market. It should be heavily bearish instead, but we've been making bullish. So the danger in here is that we've been creating distortions, and once again, this is not something you want to buy. So you're doing the way you want, but be aware that distortions will end, and that the market will have to recorrelate afterwards, and it's not going to do it pretty. Because the recorrelation phase, remember that, we've been talking about that previously, the recorrelation phase is always faster than the decorrelation, and it's always getting back to normal value. It's returning to the mean. So to me, the mean into dollar is right here, which is where the moving averages are. The lagging moving averages are just like that, been lagging in here, reselling in here, lagging in there. I'm probably going to have to test those once again, just like we've done back then. We made some kind of pullback. Expect something like that. Can be just a single and usual pullback. It can be a really a deeper and most trappy pullback like we had back then with the gold. The gold has been trapping a lot in here and taking a lot of stop losses where people didn't expect the price to go. So I wouldn't necessarily be surprised to see, for some reasons, the dollar do the exact same thing. Just going down in here, triggering all the stop loss of stupid bulls who've been buying eyes closed and thinking they will go up forever. I wouldn't necessarily be surprised to see the dollar going back then, going just back there. And if it does that, then believe me, the gold is not going to look like it is currently. It's probably going to be there if the dollar is doing this. Okay, so be aware that the risk factors are still pointing all the way down to red signals, but the market yet is trying to flush them out. As you can see, volatility has been making very low values again last week. On the end of that week, we've been breaking down the gold, yet the repo market is still trading at dangerous level, but below 2%, which means it's still free cash into the trader's head, and the junk bonds have been trying to reverse, but we're still already trying to go upward right now. So we'll see about that. It's really hard to forecast. Have a look at this quarter each and every day just to figure out what the hell Wall Street's trying to do. The higher we go away from risk level, so higher on junk bonds, lower on repo market rates, the lower we go into gold and the lower we go into volatility, the better it is. The more signs this will be that Wall Street wants to have its bubble. It's speculative bubble on top of the credit bubble, on top of the economic war, trade war, on top of the currency war, which is way too many distortions piled on top of each other. And adding a fucking speculative bubble would be the worst fucking choice ever. It's probably going to be the last ever economic cycle into capitalism if for some reasons we were about to do it. Because we will never ever have seen in history, in the entire market history, all those risks piled upon each other into a single pre-recession signals, which means if we get to recession afterwards, if those risks are showing up as the market has been flushing them out by just buying everything out, then at that point we're going to have to find new prices. And I'm not necessarily sure that the economy is able to handle a minus 80% drop into equity pricings. I mean, we can very well handle a minus 30, a minus 40%. Many minus 50 can be handled. Can be something we can handle, but minus 60, 70, 80% drops, nothing close to what we can handle. So adding new speculative bubble on top of the already existing risks we have would be the most stupid choice in terms of long-term view. So at some point, Wall Street should stop seeing short-term and seeing the bigger picture, seeing the fact that if we do this, we're just going to destroy the market itself, at least the way it exists today. It doesn't mean that something else won't show up, but the way we do see the market today will just die if we do this. Don't know what's coming next. Can be better, can be worse, can be just different, but it's not going to be the same anymore if we just get to pile those risks. It will be the heaviest amount of risk-taking we ever had. Which means we're going to be into a context that no one has ever seen before. I'm not here to scare you out, once again. I just don't know what's at play. All I know is that historically, and in terms of human history, when such things happen, such big changes, it generally profoundly gets to reshape not just the economy, but the civilization itself. And this is something that can be either good or bad, but if it's done too fastly and too brutally, it can be causing more bad effects than the good ones. So I wouldn't necessarily like to see that. I like to see changes, because anyway we're just going to move on with economy and things like that. It's something that always moves forwards. But the thing is that we want to do it with some smoothing. We don't want to change from one day to another, because the harder the change, the more brutal they are. Generally causes very dangerous side effects and negative side effects. I mean, lots of people are going to suffer from extreme poverty and things like that I really don't want to see. I mean, I'm a humanist person. I don't want to see people suffering, just especially for stupid damn Wall Street gains. I mean, what we're doing right now is just dangerous for human beings in general all around the planet. So at some point, the damn fucking Wall Street algorithms are not caring about this, but really at some point, us, human, should be thinking rational instead of just letting the algorithms do some shit out there and pushing us down the edges. So it's just dangerous to see this at play. The fact that no matter how, no matter what, no matter how many dangers we're piling, it's like the market doesn't never ever care about it. It's just like it's going to go up forever, and they trying to make you think it that way. But I don't see it that way. Everything has a hand, and I'd like to see that end not being as brutal as it should be and it could be if we're going into some nasty speculative bubbles on top of what's already at play. We're already having too many bubbles. I mean, just have a look at this. I haven't looked at the Fanged index. Sorry, we're going to get to analyze this one in here. Take the Fanged index. If you're doing this, damn it, I'm going to go just there. Okay, take the Fanged index. If you see this is clearly a damn fucking bubble already at play. So yes, a bubble can still go a lot more vertical, but we're already damn fucking vertical. I mean, those assets, starting just 2 or 3 years back then, have just already tripled their value, okay, in just 3 years. So bubble asset generally multiplies by 10. It's a general ratio that we see through times. When assets are into speculative bubble, they generally multiply the values by 10. But now just just have a look at this. I mean, Tesla at the beginning of the economic cycle Rice pricing in here, $20, we're approximately 300, so we're more than 10 times at the beginning of economic cycle. Okay, Apple, same thing. Beginning of the economic cycle was pricing $10 fucking dollars. We're not 195. We're above 200 right now, actually. So it's more than 20 times doubling the values. It's stupidly out of context. Google, still same thing in here. We've been doubling the value out of 2014, so it's more than 10 times again if you had historical prices. Same goes for Facebook, same goes for Nvidia, same goes for damn Netflix. So just think it that damn way. We've already been too far. All the bubbles are already at play. Why the hell would you think we just keep on going forever? At some point, all the bubbles explode, and I think we're already at the tipping point in which we're about to reverse to get into bursting those bubbles instead of just keeping them on going forever. So if you thought buying was the right timing, I know I can't stress that enough recently, and I've been saying it way too often, but I'd rather like to say it 100 times, but avoiding you guys to get into this stupid kind of trading that is buying damn bubbles. I mean, look at that Netflix. Those who've been buying the highs are already $100 off the prices, and we're going to keep on going to the downside. It's not going to stop. The crash is already starting, and it's not going to stop. So do as you want, but be aware that the danger trigger has already been pulled, and it's way too dangerous to fucking buy those assets. And moreover, if you're trying to buy the most expensive ones like Apple and things like that, yes, Apple still have some room to create a nasty bubble, but these are the latest assets we could do bubbles on too. I mean, Apple is the last one that could create a bubble. Tesla eventually, but it's not going to happen. I mean, like with me making 17% upward move in Tesla. I mean, what the hell is this? This is nothing close to a rational market. It's just a rangy market. As you can see, every time we go into the red area, we've been selling. So how do you really think this is going to be different this time? We're obviously going to sell in here once again. It's just a matter of time. I'm just patiently waiting. I've been triggering stop losses, which means I'm going to trade again the day right after. I'm just going to let some room for the bulls to try go as high as they can. Anytime they're going to fail, I'm going to get back in there and going to fuck them and get the stop losses in the end. So anyway, they've been getting my stop losses at no cost. I haven't took a loss in here. I just got out at no gain. That's a shame because I had pretty damn fucking great prices and didn't get to my target yet, but we're gonna get there anyway. And I think it that way. I mean, this is nothing close to ending a consolidation in here. It's just a stupid buyer market into a range, thinking that the market is gonna go up forever. All I think is that right now we're gonna fuck up all those bulls into a brutal bearish reversal, but we'll see about that. This is range trading. As you can clearly see, we've got breakdowns right in the middle of that range, so this is the mid-range. Clearly, this is where the mid-range is at play, and which means if you want to buy, you want to buy the blue area and certainly not right now the red area. Alright, so if you want to buy Tesla, buy it cheap, and cheap prices are there. It's below $230 at least, let's say below 2060. Okay, so I'm not going to move on. I'm not going to talk about this forever. I'm just going to show you another thing I've just been figuring out. I think this might help you figuring out what the hell's at play right now, because you're generally short-minded, short-sighted, not short-minded. Sorry about that. That wasn't really meant to be said. So anyway, short-sighted, which is, I've been putting some economic background right now. I'm currently trading because I've been choosing. We've been making a video, make a choice. I made a video regarding the time frames. I hope you've been seeing this one and understanding what was said in there. The fact is, right now, we've got probably bearish outcome to expect into the mean to long-term trends. So which means into the mid to long term, with basically guys who've been buying at the lows are selling right now. So the demand pressure is bearish regarding long-term trends. And midterm trends as well. So the thing is that right now we've got swing trading and we've got intraday. Swing trading and intraday trading is just kind of battling and between those long-term selling demand and short-term bullish pressure. I mean, we've got a bullish pressure into short-term trends, which means short-term traders are pushing to higher prices forever. They're buying the dips, buying the dips, buying the dips, buying the dips. But anytime we go to resistances, long-term traders are releasing the shares. So we've got long-term selling versus short-term greeding, buying the dip situation. As long as it's that way, we're going to have some kind of battle. But generally, that battle suggests the price is ranging, which we're currently doing. But in the end, generally, the long-term trends are beating the short-term trends, which means we should have a bearish outcome in here. But everything yet still think short-term and short-sighted, and thinking that as the short-term is trending bullish, we should just keep on following it forever. This is not how it goes. You do it, but whenever the long-term trend is fighting you on the opposite side, you fight for a short-term trade. But anytime the market will short-term go reverse bearish, and it's obviously going to happen. I mean, we cannot go bullish trending forever. At some point, the bullish trends consolidate, and whenever we'll have to consolidate the short-term trends, we won't have the long-term support. This is what makes the difference in here, which means anytime we go back to supports, no one's going to buy. I'm talking about the mid-term to long-term supports, the supports that Wall Street think are going to hold. So just to be showing you the numbers, so it's in order to have some sight in here. If you think that support is going to hold, if we're going there, odds to see that happenings are very low. If you think that support is going to hold, odds are very low. All we're going to do in here is rebouncing before breaking them down. So there is no longer long-term buyers. I think the buyers are out into the long-term scenarios and they're now selling, which is an opposite thing. And I think in the end they're going to win. It's just at short-term, into the short-term scenario, they might be wrong, but in the end they'll be right. These are the ones who'll be right simply because the money that is being exchanging in between hands are just making the difference. Guys who are trading long-term and mid-term have lots more money than the short-term traders, because short-term traders have short sights. They're trading really short-term. They're buying the morning, selling the evening, because they are supporting by short-term very cheap borrowing market. They can lend money for no price, but the repo market is slightly rising, which means money is costing every day a little bit more than the day before. And in that perspective, at some point, speculation will not be possible anymore. And whenever speculation will stop, short-term trends will be stopping as well, and we'll have just a long-term bearish demand, which means we're going to have just bears in the market, and that's not something good. You always want to have balance in the market. Short-term traders holding on and buying the dips, long-term traders buying the lows to just keep on pushing the bullish trends. Right now, there's nothing close to bullish trends in the long-term run. So it's either we just keep on pushing those short-term trends to parabolic mode and bubble creating, which is already in the case in the Fenget. We're already having bubbles. So that's how it is. We're already having bubble. The thing is that are we going to spread that bubble into new asset classes and extend the parabolic moves out of just the Fengets? But if that's not the case, if that Fenget bubble is already about to burst, then there's no other bubble to create, and the money will just go away, and we're going to break down supports, and then people are going to ask for the money as usual, and there will be not enough money for everyone. It's like the musical chair game. Everybody knows the music is going to stop pretty soon. We just don't know yet when exactly, and everyone is looking at the neighbor, trying to figure out if you're closer to the chair than they are. I mean, it's just really like it. Everyone's watching each other. That's what's actually at play right now into Wall Street. I've been calling my colleagues in New York who've been installing themselves out there to be professional traders as well. I mean, independent professional traders, just like I do. And they're just thinking it that way. I mean, everyone knows the music's going to end. We just don't know when and don't want to be the first one to sit. Simply because if you respect that rule of musical chairs, basically the first one who sits before the music stops is out of the game. Basically, you don't want to sit first before the music stops. So that's exactly what people is doing, what guys are doing right here and right now in Wall Street. They just keep on pushing the short-term trends because they don't want to be the first one to reverse bearish. Yet we're still having speculators who know that the music is going to end and are just trying to put themselves as close as possible from the chairs to just put their damn butts on them as soon as the music stops. So that's how it is. We're just all ears open trying to figure out when that damn music is going to stop. And anytime it will, there will be not enough chairs for everyone. And the first one who's going to be able to sit, or those who will have anticipated this, will for sure be in the train. Those who will wait for signals to get in the air, we're probably going to have the last available chairs if they're lucky and if they're fast. And those who will be too late will just have no opportunity to get out at good prices. They will just get stopped out in a very brutal reversing market because we'll have no liquidity for them, which means the price will drop and they'll have to get out at the available prices, which means far lower than what they expected to be executed on. Remember the market, you might be thinking the wrong way that the market is a casino and that whenever you press the button, you'll have the answer you want. But believe me, this is not how it works. We have extended amount of liquidity right now that is exploiting the bullish side of the market, which means we've had bullish demand in the order book for years. Right now, if we just drop 10%, no one is buying. So 10% lower from the current prices, we'll have no long-term buyers, which means if we just drop those 10%, who the hell's going to buy those sells? So we'll just have people asking for the money we're trying to sell with no one damn buying on the opposite side. And this is not a market anymore. A market is a place where buyers and sellers are meeting to find an interesting price to exchange things. If no one is there to buy, how the damn would you do you think you're going to sell something to somebody? You're not going to sell anything to anyone if there's no buyers. So be aware of this. We've been putting a lot of risks. Maybe the central bankers will be stepping in and trying to buy things you won't be selling, you won't be able to sell. But believe me, they're not going to do it for retail traders. They'll do it for institutional traders, once again, trying to save the market from desperate measures and things like that. But this is all that's going to be at play. So the only game changer and all the Wall Street guys are expecting right now is for the fact that if things go dirty, the Fed will be there to save them. It's probably not going to be the case. So we'll see about that. That's highly speculative, and once again, all I want to get to conclude to is the fact that if you're buying something that can really, really fastly get out of control, and if you're not fastly responding to problems that could show up later, you might be facing great dangers. And just to finish once again, I'm not a damn fucking perma-bear. I'm not saying this for years. I've been buying that damn bullish market years ago. And I've been buying the dips in 2016 and those things. I'm not the guy who's trying to sell forever. And just right now, the timing is to find out the long-term sellings. And the guys who are just taking their profit after 8 years of nice profits. I mean, right now, equities are overpriced. They're pretty fucking expensive. They're already reaching out to the tipping point in terms of profitability. And we've been seeing this. I mean, the Q4 of 2017 will probably be what we call the market top profitability, which means we're never ever going to make more profits than the one we've done into Q4 2017, because we've been having too many bullish stimuluses back then, which means we've had the tax plan, the bullish trends, the profitability, the cash flow. We got everything to make fucking huge profits that will never ever going to be matched again. And whenever the market has negative return over a year, means the price are going down. So we just have 2 quarters ahead of us right now to be eventually bullish or neutral. But anyway, in 2 quarters away from now, meaning 1 year ahead of Q4 2017, which means Q4 2018, we'll have to face the damn reality that the profits are negative into a year return, and this is not allowing possible pricings to the upside. This will require profit taking out of those assets and price to push downward. So anyway, anytime the price will push downward, we'll have pretty damn negative effect on equities, ETF pricings, and things like that. We'll have the exact same problems as in 2008. The products are just slightly different. In 2008, we were just selling packages of nasty bonds with high grades. I mean, we just called them AAA back then, as they were just full of shit, and people that were selling this knew about it. Okay, guys in Wall Street are just fucking damn scammers right now, just like they were in 2008. The bankers are just messing around with the clients. They're not doing this for their interest, for the client's interest. They're doing it for their own interest. And I'm going to be clear on this. What the Wall Street guys are doing right now is really, really punishable. I mean, the law should punish them because what they're doing is just scamming people for their own interests, just like they done back in 2008. Extreme greed for very personal reasons. People are selling ETFs to their clients right now, even though they know ETF is going to be fuckable someday. It's just the exact same thing as the subprimes back then. We're piling up shit together, putting it a nice grade by some kind of reasons. They're piling up some shit. They're always giving you the great names in there. So they've been putting Tesla, Apple, Google, and just selling some shit with it, calling that a bullish ETF or whatever shit they're calling this. And they're saying, okay, we've got pretty nice return out there with low risk. So let's put your money in there so you will be spreading your risk and not buying just one asset. You're going to buy 10 to 12 equities using that vehicle that is the ETFs. Just like back then, we were just selling you shitty bonds, pulled together, and selling and showing saying there's no risks buying those bonds. They're gonna give you returns, so you should just buy those and shut the fuck up. And everyone knew back then that this wouldn't end well. Everyone knew what the damn was in those packages. Just like we know what is in those packages today when we're selling ETFs to clients. And the bankers who are doing it, they're doing it for very, very simple reasons. ETF today is what is giving the biggest bonus when you're selling those, which means what the Wall Street guys are doing right now is selling that shit to their client because they're going to get nice bonuses at the end of the week, at the end of the month. And some are already asking to get the bonuses in a weekly basis. So this is really, really, really a sign of what's at play right now in Wall Street. It's really a short-term perspective. We all know that the music is going to stop. We just want to sell the more shit to people ready to buy it before it goes down. So it's just a matter of time, and the psychological and technical mechanics that were at play in 2008 are already at play right now, which means we're very late stages of a bull market, and getting in right now is just way too risky. It doesn't mean that it's going to fall apart tomorrow. It could very well be in a couple months or even a couple quarters. But the thing is that buying right now doesn't get close to any risk management. You're taking way too much risks for a very tiny possible gain. So just don't get there. Don't buy. Sell if you want to. Do it speculatively. That's the music you know I've been singing for weeks right now. I just want you guys not to buy and not to get into making the biggest mistake of your life. I could be wrong, and if for some reasons that market keeps on being bullish for years, believe me, I'll be the first one to apologize for this. But anyway, not losing money is just already a gain. I mean, that's how it works in Wall Street. You're taking way too much risk if you're trying to buy right now, and moreover if you have just bought damn ETFs. So get the hell out of there before problems show up, because we've been selling crazy amounts of ETF recently. And if for some reasons the market is about to flow out the liquidity out of those ETFs, which means everyone is going to try to sell those shits at the highest possible available price, which will be very low because no one will be ready to buy those shits, which means everyone's going to sell ETF at low prices, which means we're going to sell packages of shares, which means we're going to lower the price of those shares independently and trigger some stop losses on those shares as well, which means it's a falling apart market. The ETFs were a pretty damn great thing to push the trends higher and higher and higher, because it forced people to buy shit they would never have bought independently, and just decided to buy them together because some stupid guy in Wall Street just sold them ETFs instead of making them buying stocks like they should do. I mean, a good Wall Street guy guy should do some stock picking and telling you, okay, right now you should buy that stock, just getting out of that stock and buy that other stock, doing active management. But these guys are just fucking lazy. They are crawling out of millions and they just say, okay, why would I do some stock picking, as I just can sell some ETF to a stupid client, just take the money and run away if when things will get dirty. I mean, that's what they are thinking right now, that something's gonna go wrong, you're gonna lose money, but they don't give a shit about it. So don't be the dumb in here. Just step ahead. If you have lots of money into the market, just take part of that money out, and the rest you'll be able to do it when things will get dirty, but at least you'll have secured the first part ahead of the movement. You won't have anticipated things, and if things keep on doing well, then you'll still have 70% of your capital into the equities. But waiting for the last time to get out, waiting for things to get dirty to get out is not a rational choice right now. You should have one step ahead of the market, because believe me, the guys in Wall Street already have planned that things will get dirty. So themselves, they're not invested in equities, but they are selling those at very high pricings to clients. Okay, so speculate if you want to. Be aware that this can be only into a short-term perspective. And I'm sorry, You might thinking I'm saying this too much, but I'd rather like saying this 100 times and for you to get that, rather than having a single one of you guys buying damn ETFs or equities right now and getting into some dangerous shit if things had to go dirty. Okay, I could be wrong. All you need to get in there is that the risks are not justifying the gains. The potential gains are not justifying the heavy amount of risk you might be taking by buying right now. Okay? So, that being said, we're just going to have to watch for the EURJPY, the USD CNH is going to be the big changers regarding the latest trend determined into the technical pricings right now. So it's either Wall Street is about to fall apart and we'll see the EURJPY falling apart, and it's already been doing it the previous week, and we can expect another bearish week regarding the EURJPY. Just have a look at the weekly candle. I mean, what the hell? Do you really think we're going to have a bullish candle this week? The best we can have is a pullback, and we're anyway going to have to close lower after something like that. USD CNH, dangerous shit as well. Really dangerous bearish candle. It's overbought, but we're on resistance. So two options: either we keep on going bullish. Second option is we go bearish, and we'll have to test that price pretty much instantly. And if that one isn't holding, and I think it isn't, we're going to have some nasty reversals potential in the next following weeks. We're into bearish oscillations in terms of momentum. We are crazy high peaking in terms of momentum, yet we haven't broke the resistance. So it's either the market keeps on pushing higher, or if the market fails in here, we're going to have a deep pullback that no one has expected. And once again, I may remind you that the dollar isn't a bullish asset. Everyone think it is. Let me tell you, it isn't. If you take the long-term trend on the DXY, just have a look at this. I'm going to take images. Yes, this is what you have. The damn DXY on a monthly chart. Okay, have a look at this. Really, do you think this is a bullish asset? It isn't, and we are there right now. We're trading those prices. So let me just show you something. I'm going to try showing the DXY, the most historical way we could have it. So the XI currency index, I'm going to try doing it monthly and see how many. Yes, we've got that many in history. So look at this. Really, you think, guys, this is bullish? We've going there, we're making divergent market top. We've been failing below resistances. We've been breaking the low. Do you really damn think the market is bullish? What we're doing right now is nothing close to a bullish market. We've already breaking a support out of a bearish trend. I mean, it's a bearish range, but it's a range structure, but it's a bearish range, which means we're making lower highs and lower lows. So in that case, I think we've made a long-term top in here regarding the economic cycle. As we've made a low in 2008, we've made a high in 2017, and we're heading toward recession, and that one is not going to be good for the dollar. It's been good in 2008 to 2009. When the market crashed, the dollar was set as a safe haven, and the market got into dollar to save the losses It's not going to be the case, I think, in the next recession if it shows up. I think the market will just sell the dollar and get into other areas like the gold, for example, which is trading against the dollar, probably going to get to the yen and safer pricings like the bonds. But probably not going to buy dollar, and it's not going to be well for the dollar, I think, during the next possible recession. So don't trade that bullish. All we're doing right now is probably just a pullback. So if you're thinking that in a long-term perspective, the dollar is bullish, because everyone in Wall Street is trying to get that leitmotif at play right now, telling you that the dollar is just heaviest, it's just heavy as it's ever been, and it's going to last for long, that the dollar is the safe haven you need to put your damn money into. Let me tell you something. First, I think this is the biggest bullshit ever said to anyone. Same bullshit as selling you ETFs at very expensive prices. But I think right now the dollar is nearly close to be able to sell as we're terminating the damn monthly cycle. Look at sine wave. It's in the bearish reversal area, and we're nearing supports. We're nearing resistances. Okay, this is a resistance. We've been trading slightly higher, but we've got another resistance in here, another in there, and I think any one of those two, is going to be the bearish signal, if not already. I mean, we're just already failing, and as we've been comparing to the gold, we could just very well fail here, fuck up all the bulls who've been buying there at once, and this will just trigger Wall Street to collapse. We'll have bearish dollar and bearish equities. This is the worst case scenario for Wall Street. Means the price will just fall apart because we'll have money exiting the dollar area. And this is not something that Wall Street guys would like to see. Money flowing out will mean people will be at risk and might be requiring to get their money. So this is what they fear. They don't want you to ask for the money. They want you to be calm down and stood out, waiting for the prices to keep on going up as long as possible so they can take their nasty, nasty profits and nasty bonuses in the short term. And whenever things will get dirty, you'll have no one on the phone. They're just telling you, oh, I'm sorry, I can't sell right now. The market is not allowing me to do it. I'm really sorry, I fucked you up. But you know how it is. I mean, they're not going to tell you this. They're just going to tell you, I'm sorry, if they're just still there. Most of those guys will just be out enjoying the gains they've been making out of you and just once again fuck you up like they've done each and every cycle. They're just taking your money, making you thinking that it is low risky as it is maximum risk, and then risks show up, you lose the money, they got out and say I'm sorry. That's how it is. That's how it's ever been into each and every end of economic cycle. And believe me, it's going to be the same end pretty much sooner than later. I just don't know when. So, bye guys. I'm going to take the questions. Sorry, before we get to move on. So regarding the questions, historical August and the later months of the year tend to be lazy times for the gold. We'll see about that. If you are thinking it that way right now, you're just out of context. Every correlations and usual things that the market was trading are out of context. It's just no one is able to forecast what's going. Instead, knowing that things will be dirty, just don't know when. So everyone knows the music will stop. As I said, it's just a matter of time right now. Could be quarters, but no more than that. Okay? I think the gold is under heavy pressure for the reasons of the dollar being manipulated the way I say. They're trying to push up the dollar, but it's just a pullback to me. We'll have to sell those prices, not just yet. But to be clear about the dollar, I think what we're playing right now is nothing like something you want to sell. Okay? It's just basically an ABC correction. I think what we're doing right now is wave 1, 2, 3, 4, 5. Okay, 1, 2, 3, 4, and 5. So we're already terminated the wave 5. I'm just waiting for bearish, for bullish support to break down to confirm what I think and be sure that we terminated wave A. If I'm right, we would have already terminated it. If we fail to do it, we're just going to go slightly higher, but do it anyway. So there's no more room for the bulls in here. The bullish trend is over, and the extended wave has already been done with this one. So it's extended wave 3, so wave A is probably already terminated or about to be. We're going to make a wave B, generally retracing 61 to 76%. Then we're going to make a wave C. So if we're just respecting the usual trending strategy here, this is what we should have. Okay, this is where you should buy. And believe me, that's hell of a drop for the dollar. This is daily, which means we're going to be daily bearish for a month or two. If we got bearish dollar, we're obviously going to have bearish equities at that stage, which means how the hell do you want to buy equities if there are odds for them to go down? Doesn't mean they will go down now, just odds are bearish. So I'd like to sell instead of buying, but I could be proven wrong. The market will choose whatever it wants, and if it goes bullish, I'll trigger stop losses and wait to have further information to sell again. But I'm not going to switch to bullish anytime soon. All I have in front of me is not suggesting anything close to it. It's just a matter of time before this shows up in prices. We can keep on doing the price distortion for weeks. I don't really care. We can just keep on doing stupid pricings for an additional 1 to 2 months. But anytime soon it's going to collapse, because the higher you get into equity pricings, the more risk you're piling, the more risk you take, the easier it will be to find the trigger to just make that thing implode. Okay, the higher the level of risk, the more sensitive the trigger will be to just reverse brutally on the opposite side. Okay, but generally this is what you can expect. As you can see, tiny support in here. We're just going to do the usual analysis. God damn it, we don't have volume on the DXY. We'll see about that, but as you can see, we've been lefting some volume in there and there. So these are the two levels you might be you might be wanting to buy regarding the DXY. And as you can see, it's pretty damn bearish. Means the dollar is not going to be bullish right now. And even if we do have another bullish movement afterwards and an ABC move, that ABC move is just going to retrace and then produce some bearish outburst. Okay, so be aware of this, and this is the best case scenario, because remember, in terms of Elliott consolidation, we've got damn many options. We could very well do this, A, B, C, D, E, and in that case, we're not going to ever get back there. Option number 2, we've got also A, B, C in a flat correction. We make A, B, C, and we're not going to ever reach out to 98. Another option is for us to do this. I mean, we can very well do that. A, extended B point, and C point dynamic, which means we go even lower, and this will be the forever market top. So these are all the options to get to the big sales, okay? And this is those points that you want to sell when the consolidation will terminate. And it can either go to eventually 98 or eventually 100. This is the maximum we could get. Okay, this is how it is. I mean, I'm sorry, we've got too many options at that point, but any of those solutions is that right here, probably not going to have that much bullish potential regarding the dollar. Okay, other questions? Using the VX6 ETF reverse VIX for short positions against the market in general. I know that SPA short index is this as well. Yes, for example, you can do this. I mean, I think that's a rational choice to make. But the problem is, and I've been saying this pretty out loud recently, because once again, these are the things that professional people know about or think about, because we know where the risks really are, but we just generally don't say where they are. I think VIX is under really danger for the long-term run. I mean, VIX is probably going to disappear regarding the next economic cycle, because it's been under too many manipulations recently, and either it's going to change in terms of structure of pricing, but I think VIX covering right now and the way we do price options right now are about to change in the next economic cycle, because we're probably going to have to suffer triggering that recession because of option pricings, and the fact that they've been somehow manipulated by the computers. As you know, computers have been taking over during that cycle. I mean, back in 2008, computer trading was at its early stages. We were back into HFT trading, high-frequency trading, and things like that. I mean, right now, this is just the standard. It's like 80% of orders are executed by computers trading at very short-term trends, short-term trades. So liquidity right now is just it's crazy high-speed liquidity we're having today, and that's the standard. which wasn't the case back then. I mean, we probably started 2008 by pricing 30% of orders at very high speed. I mean, right now it's just a standard. All those like me who are trading and waiting for weeks to get the gains are just like abnormal persons in the market right now, as the market's rationality is set to be into the long-term trends, when the short-term trades are just highly speculative levels. So we are jumping into heavy speculative, dangerous areas during that economic cycle. And obviously the regulators are going to step in there. They're going to force the short-term trades out, and probably it's going to force the computers to stop trading at high-frequency trading levels, and probably it's going to stop creating distortions into the VIX pricings. I think the VIX pricings and the option pricings are faked because of false demand into the market books, into the order books, because this is this is how the banks are setting prices to either put or calls regarding the demands that is underlying the order books. Okay, this is how they do price puts and calls pricings, and as we know that the order books might be under heavy manipulations regarding what the frequency trading is doing, then actually the demand is not true. Which means if demand is not true, pricing probably isn't true as well regarding the cover. Which means we might be selling cover at too low prices. This is what we're having actually right now. Bankers and algorithms working at setting prices of puts, so which is a bearish cover pricings, they're selling those at very fucking cheap prices, which means investors think that there is no risks because puts are sold at very low prices. But does that really mean the market isn't showing signs of stress? As I do sense it. I mean, I'm a professional and I'm talking about guys like me. I'm talking with guys like me all around the globe. And they all think that something is already wrong, and we know the fear is there. We sense that fear, but we don't see this by the algorithms. So clearly something is wrong in here. Algorithms are supposed to figure out what we humans are thinking, but they are not. So something is wrong in here. There is tensions, and the VIX pricing is not showing any signs of tensions regarding the puts pricings. So I don't think that this is where you want to put your money. Okay? If you think that putting your money into the VIX, I think for some reasons the VIX is not going to implode. I mean, you can put some money into VIX and to speculate like I do, but putting more money and many money in there might not be the rational choice, for the reason I'm going to tell you just right now, and it's only a professional can tell you this, and somebody on the inside of that system, is the fact that when you have that much heavy distortions and heavy prices, and I can call it that way in here because I'm sure it is, manipulations. So if you are into manipulation of VIX pricings and put-call ratio pricings, means that you don't want to put your money in there, because that market is in there too many pressures, which means if it's set to implode or explode, you're not going to get the money in return. I mean, no one is going to pay you the cover you've been buying. Okay, I mean, the guys who've been selling the puts at very low prices will just fail and have no money to pay for that cover. So if you're thinking that, okay, I can keep my ETFs and keep my stock market, my stock investments, but just buy some puts at some and if things go wrong, I'll have to buy puts. Then let me set things straight. First, the put pricings will just explode if things go worse, and then secondly, there might be no opportunity to get puts at all, because puts are sold only if the market has liquidity to sell them. I mean, the market maker who is selling you that put is doing it because it has the opportunity to short selling the underlying equities. If they can't, they will not sell you puts. You think that the liquidity and the market we're currently trading is gonna last forever. You've never ever studied how it goes when we go into nasty recessions and when the volatility is bursting and where things get worse. The liquidity is missing, and the market is desperately searching for outputs when there's not enough room for everyone to leave out there. So, believe me, getting into where the danger is the most irrational choice to do. So getting into VIX might be good at short term to get the moment where the market is going to burst, but you have to take the gain pretty early and pretty soon, or not being into VIX. So if you do want to buy ETFs, reverse VIX, then do it, but make sure the guy that is selling you that ETF is not the same kind of guy who is selling volatility, and he's getting into that dangerous cover markets and selling you those ETFs and shitty things. Because if it does, then it might not have the money to pay for the ETF it's been selling you. And believe me, that's the worst case scenario ever. Because you would eventually take the right trading decision, but not get paid for it. Meaning you will take the risks, but not getting the reward. And that's like stealing, and believe me, that's a very, very awkward feeling to get. Because you'll be right, but you won't get the money. And I don't want you to be set in that motion, because yes, this is pure stealing out of you that will be done if what I'm saying you here happens to be right. But that's how it is. I'm sorry to say you this, but that's how it is. If for some reasons you pick up the wrong horse into that race, and if you are giving money to a horse that's not going to terminate the race and just fall in between and just going to lose its money and get into bankruptcy. I mean, if the guy who sold your ETF is out of bankruptcy and no one is buying it out, then you just lost your money. Do you really get the way I'm trying to lead you out there? It's really what's at play right now. Getting into derivative trading is really dangerous unless you're doing it throughout the right channels, which is what I'm doing right now. I think CFD is the best ever channel because the CFD is a contract you set with an independent contractor. The guys I've been buying or selling my CND contracts to, they will pay me if the market goes down, and they'll have no choice. Because we've been setting a contract in each other saying they'll have to pay me the difference. And those guys are not invested on the market. Okay, they have some money and they are trading it amount trader. They're just derivative but totally out of the market. The guy who is selling me the puts and not the puts and the calls, but allowing me to buy and to sell my CFD contracts is not into dangerous option business or things like that. It's just trying to make a damn money out of liquidity. Okay, they're kind of liquidity sellers and buyers. They are like exchanges. I mean, consider CFD as being a parallel exchange to the usual exchange that is under heavy manipulations right now, as this is where the computers have been taking over. And this is how it goes. I mean, like every time we've been into those situations, dirty things happen afterwards. And this is what I think is going to happen. And not for irrational, perpetual, perma-bearish thinkings. It's just because we've already been too far. And then we are at the stage where keep on betting to the upside is too dangerous. And we'll just have to speculate upon potential dangerous bearish reversal, and if I'm proven wrong, I just get out and try again the next time. I'm not going to hold my bearish trades like a perma-bear will do. Those guys are ruined. They are no traders. They're just selling you pure shit and selling you fear, and they're actually capitalizing on your fears. They're trying to sell you rational things, saying you the market is irrational because of this, and this, and they're going to sell you formations or selling you trade signals or shit like that. I'm not selling you anything. I got nothing to gain from saying you this and telling you that. Don't get into the danger area where the risks have been piling. ETF sector, big danger. Volatility sector, put calls, really big danger because we have a lot of price distortions out there, and this is where the money is not going to be enough for the guys who are investing in there. So don't put your money in those sectors. If you want to put the money into an interesting sector, just do it short term, and at least instead of just trying to forecast and trying to trade equities to the bear side, with ETFs. I mean, taking bearish ETFs is the worst choice ever. You are using and you are giving the money to the guys who will probably get to bankruptcy during the next recession. So don't use those guys' money to get into the market. Fucking reverse ETF is the worst thing you should get yourself into. So VXX, nothing you want to get to, okay? Or if you do it short term, and anytime you've got the liquidity to get out after a bullish burst on VIX, you just take the money and get out. Because if things went to go really dirty, I mean, don't keep that ETF for a long run. That's what I meant, okay? If you are expecting to take this and hold it all along the recession, might be a problem because the guy who just sold that ETF is probably going to die in between and not going to give you that damn money, okay? Moving on and taking other questions. Okay, we're down to the end. So thank you guys for asking those questions. I'm sorry once again the show is pretty damn long, but we're trading very dangerous prices right now, and I'm sorry to repeating this each and every day. Don't get into danger area, even though I know you want to get yourself in there because you think this is where the easy money is to be done. It can be the case in a very short-term perspective, and if that's the case, then trade it accordingly or just wait to get the damn good prices to buy in long-term. That's the only choices you have. Waiting, eventually selling for those who have the higher speculative profiles, but not buying. Buying is not an option. Bye-bye.